For a brighter future. Oh, there we go. Hey everyone, welcome to Degens for a brighter future. My name is Jorge, and today we are with Paul Stavropoulos from Archie Finance, an incredible new financial tool to help integrate crypto collateral into everyday finance. How are you doing today, Paul?
I'm great. Thanks for having me. Excited to be part of the community and just have a good time for the next hour or so.
Hey, and I'm excited for you to be here. So this is awesome. Hey, so the first thing I wanted to say, thank you so much for coming on. And for anyone who's watching our show right now, nothing we're about to talk about is financial advice. Everything on here is just an idiot on the internet and a professional. That's normally the way it goes. Do your own research, make your own decisions. And anyways, with that being said, like this video if you haven't already, subscribe to Degens for a brighter future, follow us on Twitter at DegensFBF, subscribe, links to Archie Finance below. So anyways, let's get on with the show. So Paul, how are you feeling today?
Oh, I'm feeling great. It's summer. It's hard to not have a good time.
That's what I like to hear. And I see you got that Miami sweater on. I'm actually from Miami, so I got a lot of feels for that place.
Yeah, no, my brother is in Miami. I love Miami, and this is one of my favorite shirts now. It's very pink.
I like it. I like it. Pink is what real men wear, they say. So anyhow, Paul, the first thing I wanted to ask you is tell us a little bit about yourself. I think crypto is such a new space. It's really interesting to hear about how people start, where do they transition into crypto, and then how do they get in the industry?
Cool. Yeah. First off, thanks for having me. So I guess my background is one of just someone that's been surrounded by tech for a lot of my life. I grew up in the Bay Area, the San Francisco Bay Area, and I went to school and really started learning about economics and computer science there. And I actually first heard of crypto in 2013, when I was taking a class by someone in the computer science space who is somewhat known in that circle. His name is David Parks, had a whole lecture on it. And of course, like a classic DJ, I thought it was cool and did nothing about it, which is very sad. But I also think that that's pretty common for people that got into crypto. The first couple of times you hear about it, it's in one ear, you hear about it, you think it's cool, and out the other. I think at some point I got into crypto seriously in 2016, 2017, right before that bull market, when a few of my friends just started getting into it. And, I saw the number was going up, and so I bought. And it's just as simple as that, which I feel like is, again, a common story. But I fell into the rabbit hole super quickly. Again, like I am someone that really geeks out on a lot of the economic theory and a lot of the computer science theory, and I felt pretty hard into the rabbit hole at that time.
Yeah, I mean, for me in particular, it always starts with just number go up. It's the fascination with the technology, the levels of freedom, the sort of movement of sovereign wealth that's really encapsulated a lot of people nowadays within the industry. So the next thing I wanted to ask you, can you tell me a little bit about Archie Finance and what you guys are trying to achieve?
Totally. So what Archie Finance is really trying to do is create a credit system for this brave new world that's coming, for the Web3 world. And there's a few parts to this. The first is we want to create a universal line of credit that you can spend anywhere. So let's say, I think at some point in the future, I don't know if it's next year, 3 years down the line, it's going to be totally customary for someone to make a purchase and make the following purchases in a day. Like first purchase something in fiat, then purchase something in ApeCoin, and then later on they're playing, in a decentralized metaverse, and they're buying something in like a totally other, native token. And right now, if you spend any time in the crypto space, like transacting between these different tokens is actually a huge pain in the butt. And so we foresee a world where you'll be able to have some collateral and easily spend through a mobile wallet and access device against that same collateral. But we got to start somewhere. And from where we see the biggest sort of like lines of credit that that are the biggest problems for holders are actually between the fiat to crypto bridge. A lot of people have crypto right now. Latest estimates that I've seen is 300 million people worldwide, 40 million 40 million Americans, American adults hold crypto. And the reality is people don't want to spend it. They see it as a wealth generating asset. They don't want to spend it. And so the main problem that Archie solves is being able to have people create their own line of credit that they control, that they are, they can add more to their lines of credit if they want. They can subtract, dollars from the line of credit that they need, and be able to spend against that value without spending their crypto, without selling it. And this is kind of a big deal also in this downturn, right? A lot of people have needed to sell crypto to make ends meet. I actually put out a separate debit card product last year with another company, and we saw that there's a lot of folks that make this daily trade-off all the time between squirreling away dollars and cents into crypto assets and like literally skip credit payments or bills because they believe it's their way out. And so the Archie card is designed to sort of take away that barrier to putting more into crypto and being able to spend against it at the same time in a way that most people enjoy, like a revolving credit, because revolving credit is something that's not easily accessible to people. And it just so happens that as you use this line of credit, you have the opportunity to earn card rewards as you would any typical credit card.
That's awesome. I mean, one thing I really like about the concept is that most people have access to crypto right away. It's got a much lower barrier to entry than some other financial tools. You know, a lot of people are like, man, how does Elon Musk avoid paying taxes? But a lot of that is because he's using his assets as collateral, so that way he can spend that liquid cash. And whether, well, I know he doesn't own any houses anymore, but whatever it is, his private jet, I think, is the only thing he owns. I think. Don't quote me on that. But I really like the angle that you guys are going here, because I actually do know several people who put off and make those kind of decisions. So out of curiosity, one thing that I did want to touch on with you is, right now, I think what we're seeing is sort of this mass deleveraging, within the market right now. Obviously, your system involves using your crypto collateral so you can have access to liquid cash. Out of curiosity, or to be able to access the metaverse and buy cryptocurrency or NFTs or whatever the case may be. But out of curiosity, what do you think are some of the challenges that that services like Celsius and BlockFi kind of ran into offering similar products?
Yeah, I mean, look, I think that's the elephant in the room, right? Like,
right.
I mean, we need to talk about this. So I think there's a few big things, and at the end of the day, Jorge, like from what I've seen and from what I know, it kind of feels like that Celsius and BlockFi, even firms that aren't associated with collateralizing firms, but firms like 3 Arrows Capital, we've basically gone through a point where we've relearned and like actually internalized lessons that like people in the traditional banking space like have learned hundreds, maybe thousands of years ago. And because this is such a new space, we've seen those problems like kind of come in our face really quickly, like in the last couple of weeks. So there's a few things that really happened that like we are lucky enough that we're gonna lean on the shoulder of giants and not repeat, right? So the first thing is diversification. If I recall, I think Voyager recently came out, or news about Voyager recently came out, another sort of like what they call this DeFi mullet product, a high yield savings product that turns out that like roughly 50% of their allocated portfolio was actually locked up or given to 3 Arrows Capital to rehypothecate, right? Like, wow. Diversification 101 in any, whether you're a bank or an institution or even an individual, you probably shouldn't have 50% of your assets in one place. Like, very, very simple lesson. Right. The second thing that I think we learned really we've actually internalized is the idea of like liquidity and liquidity preference. A lot of these funds were put in places that didn't, like, you couldn't pull out again. And that's fine when everything goes up, but it's a huge problem when you are leveraged over, like, over the moon, right? The classic example there is the staked ETH and the ETH depegging, right? Like, one staked ETH does not equal one ETH. Everyone sort of, if you read the documentation, like page 1 of the documentation of staked ETH, it becomes very clear that they're not equal to each other and they can very easily depeg. But a lot of people basically treated that as the same thing and assumed that it was just as liquid and it was going to be the same price. And then the third thing that I think we're seeing is just like safe trading practices, right? So I think it came out recently that, or actually a few months ago, that Celsius lost like some hundreds of millions of dollars in a hack. Because they were trading through a MetaMask account with, I think it was called BadgerDAO, like a new unproven sort of protocol.
Right.
Turns out, like, if you're trading hundreds of millions of dollars, you probably shouldn't be using brand new, unproven protocols, and you probably should be trading from somewhere that's more, has more controls than just a MetaMask account, right? Like, a lot of these things are like, investing 101, whether or not you're an institution and you have other people's money, or you are yourself and you're doing your money. And so we're very much not going to repeat that. I also think that the other big difference about Archie is that, like, we're not a high yield like wealth deposit place. Like, we do not want you to put your entire wealth in Archie. Archie's purpose is for you to put some percentage of your holdings into a place that will get you a line of credit and get you rewards. And the rewards that we're talking about are on the order of like 1% and 1.5%. It's not something that is promising you 10, 20% returns on the entire portfolio of your savings. And I think that those are very, very, very different. We can dive into that as well.
Yeah, of course. And honestly, it's very refreshing to hear from someone, I guess if you don't mind me paraphrasing, but don't degen everything into Archie. And that's actually a really refreshing thing to hear. Seldom do we hear people say, stay diversified. And especially one thing at Degens for a Brighter Future we try to do is, I'm not particularly a great trader. I just hodl and mess around with some DeFi here and there, and I think it is very important to be responsible and secure with everything you do. And I definitely see that right now we're in a heavy era of skepticism, and I definitely do want to ask you about Archie rewards. But before we jump into that, one thing I also really enjoyed was that how you can offer a credit card, but you also offer Archie Pay, and that like allows you to enter into the Web3 space with your debt, or you can take it and you could spend it in cash. Could you go into a little more detail on the product and offering?
Totally, yeah. So I think I started off by saying that what we're really trying to build is this universal line of credit, and really the Archie card is the first access device into that, and it's the perfect first access device, right? Again, the biggest problem for most of the 40 million Americans and 300 million people that hold crypto is they can't spend their crypto at the grocery store, at the movies or whatever, right? So that bridge is the most important bridge to solve. Another access device into this universal line of credit is definitely a wallet. And once you have a wallet, whether it's through a plugin like MetaMask or through a mobile through a wallet like on a mobile app, you'll be able to use the value of your collateral in basically in the Web3 space. And what I'm really excited about, and I like what keeps me up at night in terms of like thinking in a fun way, is right now in our traditional finance world, I don't know, sometimes I use Web 2 and traditional finance world interchangeably, but like in our IRL, in our real lives today, we interchange between spending things with credit or on credit and spending things with cash or on debit, right? Like this idea that I want to buy this thing now, or like I want to buy this thing and be able to pay it off later, has created like this world where we don't even think about some of the, like how we're purchasing things. We just do it with whatever's more convenient, and it's just so internalized. And that decision hasn't yet been brought into the Web3 space, where if I want to buy some merch from the Bored Apes and they only take ApeCoin and it costs 50 ApeCoin, but I only have 40 in this wallet, and then I have like 10 in another wallet, do I want to go ahead and take the time and pay the fees to like aggregate my 40 ape in one wallet and 10 ape in one wallet and put it in one wallet, and then use that and pay those fees to like buy this sweatshirt? Or do I want to buy that on credit through like this ArchPay mobile wallet, buy that and just like pay that later and settle that at a different time? Like, it's just so convenient. And it's sort of this parallel that we see. So really what we're looking to build is this, we call it Arch Credit, this universal line of credit that's got a few access devices, and ArchPay is one of them. And we're really excited about the world. There's this whole other world that you can think about making payments with merchants on ArchPay, and with other people using ArchPay as well.
Hey, and I think that's also a really great gateway into financial inclusion. There's such a large portion of just the global population that still doesn't have access to a bank account, but has access to a cell phone and likely can, hold crypto and then readily go into a supermarket or something and spend that cash and then go back and cover that collateral. So what I wanted to ask you after, when I was reading the white paper, you had a really interesting piece in there where you described that what DeFi needs is a sort of trustless trust. And I was curious, that was a very eloquently written section of the white paper. I was hoping you could go ahead and elaborate exactly on what you meant by that.
Oh, totally. And this is gonna, I can't wait to talk about this. So right now, I think the beauty of DeFi and crypto in general is that it is by nature and by default an open ecosystem where anyone anywhere can participate without any gateway. Once you have crypto, you can make decisions that for yourself without any intermediaries. It's beautiful. However, what we give up is just a lot of the trust that we have baked in our in real life lives. Trust, like if I use a credit card and I get scammed, there's usually a way to settle that. Trust, like if I want a haircut, like I can just go on Yelp and like find someone that's rated 4.5 or 4.8 or 5 stars and just get a haircut. And that doesn't exist in DeFi, right? Or really anywhere in the crypto space. And if you try, you'll fall into like this deep rabbit hole of like discords and like anonymous personalities to like figure out who is trustworthy and if this anonymous persona is trustworthy. In DeFi, we've gotten around the problem by basically relying on over collateralization, which is fine for the roughly 10 million people in the world, or I should say 10 million wallets in the world that partake in DeFi. But that's not going to cut it for most people, because that's just not it's not a smart way of using your money. And so when you think about DeFi, a large part of it is based on lending and borrowing. And if you think about it, borrowing and extending credit to someone, like borrowing is the personification of trust, right? Like I'm not going to lend to you if I don't trust you. Right. Which means that I trust you. And so it turns out that even in our everyday lives and on DeFi, there's actually a huge element of trust in every transaction that we make, even though it's all in DeFi, it's all anonymous. And we don't know who it is. Like there's an element of trust. And I think one thing that we're excited about is with use of your universal line of credit, with use of your Archie, with use of your Arch credit, you'll be generating sort of on-chain interactions about your repayment history, about whom you are spending with. Also, like whenever you sort of buy things with the Archie card, you're interacting with the real world. And there's a way where we can sort of come up with a trust score for you that you can use with counterparties in the Web3 space. And there is a way, there are primitives out there where this score can be generated in a completely privacy preserving way, where no one else knows what the score is. And it relies on you to hold a lot of information encrypted on your device that you can share with others. But they're trusted because you can sort of see who are the parties that are signing, that are creating these signals. And so what Archie is really excited about is providing a way based on the signals and the use of your Arch credit to come up with credentials that you own that live encrypted on your device that you can use without Archie really being involved with other members in the Web3 space to establish trust in a trustless way. Like if no one trusts each other, but we have these credentials that say that this person has a good standing with Archie, is that they repay their lines of credit, down all the time, or this person is verified to be a US citizen and has, an Archie score are higher than this. I don't need to know their name. I don't need to know the social security number. I don't need to know their age. I just need to know a true false Boolean of, is this person trustworthy in the eyes of who they've transacted with and in the eyes of Archie. And I think we're really excited about this world. The primitives are being built. There is this concept called verifiable credentials that we can get into that powers a lot of this stuff. Some folks that are true Degens might have recently heard about soul-bound tokens, which were presented by Vitalik.
I was going to ask you about that.
Yeah, those kind of come into play here, but there are ways where a lot of these things combined with cryptography create this this private, trustless, trusted world that just is so exciting. So I'll stop there so we can sort of take the conversation in many different ways.
No, but actually that's a part of the conversation that I'm actually very interested in, because obviously on the one hand, and this was one thing that I was interested in, you're playing also in a bit of the TradFi space as well. So when you are offering a credit card in the US, there's also a layer of KYC. However, what I do find interesting here is that based on what I was reading, it sounds like you could take the Archie score, you can be part of, say, a DAO, and then the DAO can be like, well, if you're going to be part of this committee of people that help with the treasury, can we all take a look at your score? But there's no need to show your name, which I think is a really powerful use of the technology. Out of curiosity too, what I was going to ask you, so is the Archie score going to be like, would I have to go through the Archie page to show that information, or would it be like an NFT that's being held in my wallet, and whenever I access Archie, it's updated? How does that work exactly?
That's a great question. I'll share with you how we're thinking about it now. I will say in full disclosure, we're probably 1 or 2 years away from actually having this stuff built out, but I'll share what the latest thinking is, and based on where the primitives, where a lot of these tools are today. No, you will not need to visit Archie. However, you will need to provide the counterparty explicit consent to access whatever information you would like them to see. Whether that happens in a wallet, whether that happens on the Archie page, that doesn't matter. But what matters is in the verifiable credentials world, that the counterparty can only see, because of cryptography and what you've encrypted, can only see what you give them access to see. So if someone all of a sudden wants access to see your Archie score, your name and your social security number, you have the option to decline that request. So, because you don't want to give that information. But if a user is asking just to see your Archie score and that's it, you just give them the ability to decrypt that, and you can send it. You can have that sent to them.
Very cool. So one other thing I was really interested in kind of diving into as well, going back into the use of the card itself. What I was really curious about, although it's not at least based on what I was reading, the rewards that were pretty out there from Celsius, Nexo, and BlockFi, definitely it is appealing that this is kind of passively generating rewards as I use the card. Two questions. Is that also applied to Archie Pay, like when I'm accessing Web3? And also, how are you generating, excuse me, sorry, too many sparkling waters. Anyway, how are you generating that yield as well for those rewards?
Got it. Great question. So let's start with the last question. So the rewards yield, the rewards will largely be funded from the yield that we'll get from rehypothecating collateral, from reinvesting collateral, which is why, because these aren't like 20% returns whenever you spend money or what have you. We're not out there sort of traditionally like perhaps Celsius or other firms were chasing huge yields. We're really looking to just have a stable return on our collateral. So we're not doing anything crazy. We're not going to invest in weird assets. So the rewards generate from the collateral and the rehypothecation. That also means that we're not looking to make money from folks by charging high interest rates. Or anything like that. It turns out that when you have a collateralized card, it actually aligns the incentives in a really beautiful way, where I'm not going to make money because I'm going to charge you a $300 or $500 yearly membership fee. We're not going to charge you 30% interest. A lot of the incentives are aligned in that Archie will bring you goodness and we will generate yield for you and ourselves if you keep your money with Archie, and we generate yield. So it creates kind of a win-win situation. The way that the Archie card rewards will work is that there's two parts. We will give rewards on cash back like you would, with a lot of other cards. You'll earn roughly 1% cash back on any purchase that you make. But again, we win when you win. So when you pay down your balance, we win because that means that you're in a good standing and it keeps your collateral in a good standing. And so we've come up with this concept that we call the Archie bonus. And the Archie bonus is an additional 1.5% yearly yield on your collateral paid out every quarter when you pay down your balance in full. And the reason why that works is we want you to pay down your balance. We don't want you to keep a balance because we everyone wins when your collateral is kept in Archie. And there aren't many cards out there that are sort of like trying to find ways for their users to spend responsibly. It just so happens that spending responsibly is super sexy right now. That wasn't the case like a month ago or 2 months ago. So it's boding well for us. Then you brought up this question about Arch Pay. So when you make a credit card payment, the thing about credit cards is that they're actually a tax on people that use cash. Every time you use a credit card, the merchant is responsible for somewhere between 1 to call it 3 or 4% of the actual charge. It's kind of why whenever you go into a liquor store like a bodega, they don't want to accept the card if you're spending less than $10, right? And so whenever you make a digital payment, like a wallet-to-wallet payment, like you would with Arch Pay, merchants won't have to pay an interchange fee. Like it's great. And so what we plan on doing is whenever, let's say there's a merchant that will accept Arch Pay, typically that merchant's going to be charged, call it 2% or again 3%. We'll make an option for the merchant to take a portion of what would have been charged if you were using a credit card to give that back to the user as a reward. Now that's really, really exciting because it kind of creates a world where merchants should be competing with one another for basically reward systems, if they would like, right? And so you can imagine a world where if you're using Arch Pay and you want to buy, I don't know, you want to get a haircut, one barber will, let's say that there are 3 barbers that are effectively the same quality. One is offering, 0.5% back if you use Arch Pay. The other one's offering 1% back if you use Arch Pay. It creates a super competitive world that really, really, really benefits the consumer. And the merchant, is going to make more money because they shouldn't give back the 3% that they would have been charged if you were to pay in credit card. But it's only fair that some of that goes back to the user. And so this, again, it just creates this open world where merchants can make decisions for themselves to reward consumers for using their services and buying stuff from them.
I mean, what I like a lot too is that obviously they're avoiding these 3%, 4% fees on top of all of these transactions. So there's always going to be an active incentive to have the Archie consumer come in. But even if they don't participate, it's just a net benefit, for everyone involved. Even if the person is just, like maybe a small convenience store in town and maybe they never heard of Archie Pay, but suddenly they see the transaction coming in full. And that's really cool. I might have missed that in the paper. So that's phenomenal. You mentioned that. So the next thing that I thought was really interesting was some of these alternative methods to pay off your collateral in a given situation. I was curious I was wondering if you could dive a little bit into the debt market and the escrow system that is involved. When I was reading it, as I understood it, it's like maybe you can't cover your entire collateral, so you offer it as a debt to someone else so they can purchase, say, your one Ethereum. Maybe you're going to sell it at a discount to someone else. So that way you can at least get most of that money back. I was hoping you could dive into that a little bit because I see that as a really excellent opportunity for people who might want to be in an arbitrage opportunity or to play an arbitrage.
Yeah, no, totally. And I'm going to take 30 seconds here and sort of bring it up a level before diving into that. So I think
Sure.
the reason why I first really fell into the crypto rabbit hole is because, well, in one word or in one sentence, I saw blockchains and crypto being like the new age refrigerator. And what I mean by that is, if you look at refrigerators and the history of ice and making ice, turns out that there used to be, back in the 1800s, we used to literally mine ice out of lakes. Literally, the Eastern United States and Norway were top ice exporters. If you lived in India and you wanted ice, that was literally shipped from Norway, and you were an aristocrat for having ice in your drink, right? At some point, we discovered that we can make ice in factories. And so if you lived in Las Vegas, there was a factory near, and there was this whole transportation system and ice wagons for you to have ice delivered, right? And then lo and behold, the refrigerator was invented in 1899. It wasn't until after World War II where everyone had an ice machine in their kitchen. But can you imagine how powerful that was? That without thinking about it, if you grew up between 1899 and 1960, by the end of your life, without thinking about it, you were able to just make ice in your kitchen. And how many decisions that opened up, right? All of a sudden you can have ice for your drinks, you could freeze meat, you could buy eggs from the grocery store and that could last for more than 3 days. Your life just changed because of this simple ice machine. And crypto does the same thing, and DeFi does the same thing, where it puts all this power into the hands of the folks themselves, without this intermediary sort of mess that's needed to make things happen. Right. So all of a sudden, let's say if you have let's say you have one Ethereum backing your line of credit, and you're in a pinch and you need to get access to your funds, right now. And you have $100 in an open line of credit that you need to pay down, but you need cash now, and you have let's say a price of Ethereum is $2,000. You have $2,000 of crypto. You need to pay off $100. Well, what you can do with a few clicks of a button is sell your Ethereum for a small discount, call it 2 or 3%. So the end person will buy it for, call it $1,900 and 1990. So $1,990. So call it as a $10 discount, which is great for them because they're not buying it at $2,000.
Right.
And within a click of a button, that user gets a discounted Ethereum, and you get $1,990 minus the $100 that you owe into your pocket. Done deal. That's it. There's no bank involved. There's no ACH 3-day settlement period involved. There's no clearinghouse. There's no escrow involved. all the parties are known. It all happened in code in a matter of, minutes. Like that to me is like the new ice machine, or like one aspect of like refrigeration in finance. Like there's like, we don't even think about it. Like it's so convenient that like I don't need to make decisions until like I need to access my money right now. And there's a buyer that's on the other side ready to buy it. One click of a button, two keystrokes, and I'm done. I have my funds. So that's the secondary market, and why, like in general, why I just fell in love with crypto and DeFi when I, first found out about them.
I mean, I also like this as well, because now there's a lot more confidence. You can manage your risk a lot better when you know that if push comes to shove, you need that cash right away. You can do that. You can use that as a tool to get liquidity faster. So I mean, I think that's really cool. That's another element, I guess, of trustless trust. I really like how you wrote that down. I don't know if you wrote that, but whoever wrote that, fantastic. So one thing I wanted to ask you, going back to the Archie score. So say I'm a user, I've gone 2 years paying consistently. I've gotten my bonuses, but what are some of the other opportunities? I recall reading something about under collateralized loan as well. I was wondering if you could dive into that a little bit, and also the benefits of increasing your Archie score.
Got it. Yeah. So, you asked about this term trustless trust, and I think I did write that, but I think I like massaged it or stole it from someone that I consider kind of like a mentor figure to me. And this other phrase that he said, and I think I've like flashed it here, is that again, credit or extending credit or loaning to someone is the like personification. It's the embodiment of trust. Right. The reason why over collateralization is so prevalent in the crypto space right now is because, well, we don't have a way of trusting each other. That's it. If you live in the United States, like, to make this very real, right? If you live in the United States, there's this aspect of a FICO score. We can talk here and shit on the FICO score all day because it's really not a great system of trust, but it is used as a system of trust. And if you have a good FICO score, it opens up this world of buying a house, getting good credit to the world. We just don't have that. So we all rely on over collateralization. The whole point of the Archie score is to sort of create like a privacy preserving, decentralized, idea of trustworthiness that combines on-chain sort of metrics and aspects from your everyday life, aspects from the Web 2 world. There is no reason that if we can understand how trustworthy you are, that, at first, maybe the LTVs or the amount of the size of your credit line will increase. And then let's say your Archie score is again really good. There's no reason why we can't take an NFT as collateral. And then eventually, let's say you have a great sort of Archie score. There's no reason why we can't extend an under collateralized loan to you, or eventually an unsecured loan to you. If you have made your payments, I don't know, for a long time, for years or months on time, there's no reason why we wouldn't be comfortable. Once we understand a risk model, we wouldn't be able to extend an under collateralized loan. Now, the beauty of that is that because these are open protocol systems, and the Archie score is going to be on an open protocol, there's no reason why other protocols and entities and DAOs can't use the same mechanism to make the same determinations for whatever good trusted actors should have access to, right? You gave this example. Like, there's no reason why I can have a vote in terms of like how to allocate this DAO's money if I have a good Archie score, or maybe I can be part of some exclusive investing DAO if I can show that I have good repayment history and I'm good for my payments, I'm good for my money. Like, the point is that we not only want this to power decisions for Archie, but we want it to power decisions that like we aren't even involved in. We are just the ones that issue these credentials and like have generated the score, but it opens up a world for other firms in the space to do what they want with it for users that they deem trustworthy.
Yeah, I think that's a very strong tool. As a counter argument, though, out of curiosity, is there a concern that an Archie score could become exclusionary? Does it take into account how big the collateral is, and does that affect the score? If I say I'm low income and maybe I have $1,000 of Bitcoin, I need $500, I pay it off on time consistently for a long time. Is it taking into account when it creates that score just how much liquidity is going in and out of these collateralized loans?
That super glad you asked that. This is going to be a bit more of a nuanced answer. The short answer is no. We will not. The whole reason why we want to create an ARCH score is for two reasons. It's because there's a general understanding that our current way that we determine who is creditworthy is not it's not great. Like, we cut out entire classes and frankly races from people to access credit because of these scores. And secondly, we think that future sort of trust can't just be something that's dependent on just Web3 rails, right? Like, in order to understand someone's trustworthiness, we need to understand what they do on chain and off chain, right? And so those are the premises of the Archie score. So the amount of money that you have collateralized is not going to be a factor of like what your Archie score will be. However, there are going to be cases where like people are going to want to know those items. Like, there's going to be times that someone may want to know, like, does this person have more than $10,000 in their bank account? And for questions like that, what we're going to do is effectively create a whole other set of credentials that, again, you will own, that if you choose to disclose that to whoever's asking, you can use. But in terms of powering the Archie score credential itself, that's not going to be a part of it. We'll have other sets of credentials, to ask for folks to ask those questions and understand that about their users.
That's very cool. No, I mean, I'm glad that there's that balance in there, because that's always been a challenge I find with the FICO score, because it doesn't take into account like what that person might be going through. Did they have a serious loss in the family and had to drop their job and, couldn't make a certain payment, and so it's nice to hear that you guys have taken the time to really put a lot of energy and try to make this accessible. So the next thing I wanted to ask you, let me see, what was it? So now what I wanted to know is you have the Archie score, you have Archie Pay, you have Archie Credit. Out of curiosity, I know that the product is not launched yet, but how is the Archie token going to play into the product itself? And also, out of curiosity, I noticed I couldn't find information on a chain. Is there a certain blockchain that you're looking to launch the Archie token on?
Great. Also, more great questions. So I think the point of the Arch token is, I think in short, it's going to be a governance token, right? And I think the thing about governance, and this gets into questions about DAOs and whatnot, I think the DAOs are such a powerful concept. Just like the refrigerator in 1899, I think it's gonna be impossible for us to sit here and try and think about all the ways that DAOs are going to like affect things in 20 or 30 years. But I like the idea of it. I think the reality right now is that DAO participation is such that, like, if you have 1,000 people holding a governance token, it still is like 3 people that are actually voting, right? And if you look at a lot of like DAO voting allocations, it's a fairly dismal amount of folks that hold these tokens. And so we're really interested in having a governance token because, again, people's collateral is what's powering their rewards that they earn, and they should have a say into some of the dynamics that go into where their collateral goes, their reward structures, etc. But I think the honest truth is that we haven't really thought that much deep about it, which is probably why you couldn't read that much into it, because I think it's just too easy to say that it's going to be a governance token and that's it. What we do know that we want to do is, A, we know we want it to be a governance token, and B, there aren't many things right now that people can do to earn crypto, right? Like, I think that's part of the thing about like this play to earn movement that's come up that's very interesting. And it has some of its shortcomings for sure, but there aren't many ways for people to earn crypto. And being able to like, have a card that, as you spend, do your everyday activity, earns you crypto. There's an opportunity for people to also earn, the governance tokens so they can earn their way into having a say into how things are run. But we haven't really thought much about the dynamics. The Arch token isn't really central in terms of like getting the Archie ecosystem off the ground, and so we haven't really been focusing on it in totality right now. Which, by the way, like, hot take, that's okay. Turns out, not everything needs a token, at least to start. And so we haven't really been focusing about it.
Okay. No, and I think that's great that you guys are still kind of working on that dynamic. And it's all right not to have all the answers today. On the next time I have you on the show, maybe you will. I'm excited for that.
I love it. I love it.
Awesome. So now I wanted to ask you, so we're gonna do a hypothetical. 5 years from now, you're at the top floor in a building in Manhattan. You're overseeing all these cars moving, or maybe not Manhattan, it's not as crypto friendly. Let's say Austin or Miami.
Let's make it Miami. Let's pick
Miami. Miami's the best place ever. I still love Miami. Whoever watches this, don't hold it against me. Anyways, with that being said, so you're at a tall building in Brickell, and you're looking over the skyline. What is the status of Archie that you're trying to accomplish? And I was curious if you could run me through that.
Yeah, give me like 10 seconds because I'm going to incorporate a whole bunch of stuff together, because you've literally given me permission to go crazy.
That's the point.
Okay. Here's what I would like to see. And again, I'll caveat this, and I invite anyone who has thoughts and shortcomings here to, like, talk to us and hit us up on Twitter, because this is a dream state and there are so many things to still figure out. In my dream world, in Miami, people are not only earning money, in US dollars, but they're also earning money in Miami coin, right? Because Miami coin is what's called an alternative currency. And I think that there's a huge advantage to having an economy where there is a main currency, an undisputed main currency, called the US dollar, but that every region, or that every subculture, or that every, however way you want to, denominate this, let's call it city in this case, that every city has its own coin that can respond dynamically to the needs of that population, or specifically underserved population in that city, right? So there is a way for folks to earn money in US dollars, and in Miami coin, and that people are collateralizing and putting their money, or at least some of it, let's call it $5,000 or $10,000 worth, as collateral into Arch, into their credit. And every day, someone wakes up, they're buying their cafecito, their coffee in dollars, right? They're buying it, it's cost $2. They're buying lunch from the local vendor down the street, like a nice Cubano sandwich in Miami coin. And then they are like going to an event later. They're going, let's say it's a Friday night, and so people are like waiting in line for the club, and the club just needs to know that you're older than 21 years old, right? That's all they care about. They don't need to know your name. They don't actually need to see your ID, right? They just need to know you're above 21. Right. Some folks whip out their Archie, their Arch Pay wallet, where there is a QR code. They scan it, and it shows a credential that says true. This person, as verified by like the city of Miami that has issued this wallet, the owner of this wallet, this credential that says they're above 21, this person is indeed above 21 years old. Some other people whip out their actual physical Archie card, which has a QR code on it. Because why don't credit cards have QR codes on it? When they scan it, it takes them to like a profile page of the actual person in front of them, and it shows their photo so they know it's them. It's maybe some other information, and like there's a big green check mark because the person has that when that device that scanned that card has asked them to see if they're above 21 years old, and indeed they are, so they're entered into the club. And then this person has basically paid, for things throughout the day in like different currencies.
Mhm.
It's June 30th or June 29th today. They need to pay down their balance, and across the entire month, they've made payments in Miami coin, in US dollar, in Ape coin. They've bought an NFT in some weird other token, and they're told that they owe $1,000 from all those purchases, and they can pay that down in $1,000. They can pay that in point 1 ETH, because ETH is now worth $10,000, obviously, or whatever other ways that they'd like to settle that. And within a few clicks, they've gone and settled that. They've cleared their balances. They've earned some rewards, and they go on about their day. They're going on about their night at the club. They wake up the next morning, and all this just happens seamlessly without anyone thinking about all this. It's just present in life that we can make payments and interact interchangeably easily with a few QR codes, or exchanging some information, and using devices that everyone has in their pockets.
Wow. Yeah, I mean, this is quite the image. I might need to put this in one of my clips. This is an interesting view of the world. I like it. I gotta ask you now. So obviously you're in between the centralized finance, and also there's a touch of DeFi involved. There's definitely a lot of inspiration from MakerDAO here. I wanted to ask you, where, with everything that's going on in the crypto industry right now, we also have the bill from Cynthia Loomis, which needs some changes. I got my fingers crossed. And out of curiosity, where do you think regulation is going from here? That might be a long-winded question, but I'd love to hear your thoughts on that.
I wish it could be a long-winded question, because I think a lot of it is just, I think a lot of what people are interested in talking about is regulation in the short term and what's going to happen. And I truly don't know the answer to that. But what I do think that there's a few things that I'm excited about, and that I'm definitely looking at, right? So I would say that, and I hope that this clip gets played back to me in like a few years and I'm totally wrong. I do think that a large part of better regulation, I think, is going to first come outside of the United States. Just today, June 29th, I don't know what governing body, but the EU basically made a decision that any money exchanged or sent to a non-custodial wallet will not need to fall under the travel rule. Or if I want to send money to a non-custodial wallet, I don't need to report the amount, the person's name, their address and all that. So they voted in favor, actually, of kind of keeping more in line with the crypto ideals. So I'm actually seeing kind of more not clean, but more like good discourse, but a lot of discourse happening sort of first outside the United States, right? I think last month or 2 months ago, Germany also recently announced that there's going to be no long-term capital gains on crypto, or I don't know if it was specifically Bitcoin, but yeah, I think it was actually specifically Bitcoin. So I'm seeing like good regulation first happen outside of the US. And I think what's going to happen is that the US is eventually going to catch up, because there's going to be a lot of pressure. Or the US might get it wrong, a little bit wrong in the short term, and then there will be some folks that'll leave the US, or money will leave the US or something, and the US, I'm sure, will eventually course correct that. What I am pretty convinced about is, so I'm not really sure about the short term, but that's kind of what I would bet my money on. Crypto and blockchain and an open financial system is more incentivized in places where you're not the reserve currency for the world. Like I think that's probably true. But I do think in the long term and in the medium term, we're going to get it right. And I sort of see this world again of verifiable credentials, or trustless trust. This world where there are still government bodies that are issuing credentials that I own, that live on my device, that I can choose to share them with people if I would like. I see that sort of being where we're going to end up, because in that world, I get to choose if I want to engage and partake in services with in the non-custodial world, or if I want to partake in services, that require me to expose all the information that I need, to make transactions, whether it's names and addresses and social security numbers. And those primitives are there. There are people working to like make that a reality. But yeah, I mean, I think I think that we're like in the trenches right now for the next, call it, year and a half or two. And what I would say is that it's a good sign because we're growing, right? Like, it was cool back, in 20, and I'm like not a crypto OG by means of like, people that have been in it since like 2012 or 2013, but like, it's finally very cool to see like actual good discourse happen on the Senate floor and happen abroad. Like, I do think, I can see as Archie, like the hardest part of Archie and making that come to life right now is actually working with the traditional finance world, because it's still at a point where I think banks in the traditional finance world have finally realized that this thing is here to stay. And some are doing it with open arms and some are doing it begrudgingly, right? Like, actually the on-chain methodology of Archie, like, it is very cool and interesting in some cases, but it's pretty well understood. The traditional finance part is like where we're sort of spending a lot of our time bringing things together. But at the end of the day, like, this discourse is happening, right? Like, we used to be left out of the room, before the pandemic, and just being able to see that these things are actually being debated, that people like, Chris Brooks, SBF, like are coming to the Senate floor and like are actually providing like good takes, like, that's great. So I have full confidence that we'll get it right in the medium to long term. I do think it's going to be a little bit, painful here and there whenever we see some politicians say something that might not be as informed, when we'll see a draft of something that has good intentions but not quite there. I think it's going to be a little painful. But I wasn't alive. I wasn't old enough to be like really understand what was going on when like the internet was first, becoming big. And Congress needed to make some decisions there, and people needed to come up with regulations for the internet. But I kind of sense from people that have been there, when I hear them talking about it, kind of feels a lot like that. And so I think that's a great thing. I think it means, yes, we are still early, but it's going to be painful. It's going to be a little bit like riding a ship in rough waters, for the next year or two. I think we're headed in the right direction, though, in the long term.
No, I'm glad. I mean, I'm with you on eternal optimism there. So I'm hoping that things get better as far as regulation is concerned. Always one of my things is, as I love the product as you've written it, or as a group have written it. And I think it's also important that hopefully these regulations will allow for people to still self-custody their assets without a third party, right. Can choose to to keep their wealth sovereign if they so choose. I think should still be a part of the equation. So there's a couple people out there that want to make sure that's not possible. And I have my fingers crossed that that's not the case. Hopefully the BIS never gets their way. Anyhow, shout out to the BIS. Don't hunt me down, please. Anyways, so I guess the next part of the conversation that's unraveling is you obviously maybe you're not the veteran from 2013, you're the veteran from 2017. We're in the midst of a really harsh bear market that I don't think it. And this is just my personal opinion, and I'm just a fundamental investor. If I see value, I hold. I don't make it complicated. So out of curiosity, where do you think the market is going? That's always the fun question that people love to ask, but I had to ask you. And also Joey insisted that I ask you that question. So
okay,
shout out to Joey if he's watching.
I have this thing where it's a lot more fun when there's a bullish market. But people always like to ask, is Bitcoin ever going to hit And like before they can even finish the sentence, I always say yes. I can see Bitcoin hitting 100,000, $1 million. I can also see Bitcoin hitting, staying where it is right now at around 20K and hitting, 11 and 12. I too am not a trader, right? I'm here because I like refrigerators and I want more refrigerators, right? I want people to seamlessly be able, without a moment's hesitation, be able to deploy their money to do things, whether that thing is to build wealth, to make payments, to make more money, to have a vote in something, to have access to some party or some community because they have an NFT. Like, I'm here for the refrigerator story. I want more refrigerators. So I'm convinced that this refrigerator story is going to happen. I don't know if Bitcoin's going to go down to, is it going to go down more? But again, if people have, like, when people ask, is Bitcoin going to hit? My answer is always yes, before they even finish. And I stand by that. Like, I'm not selling. I'm looking for ways to acquire, more, even at these prices. I'm not selling anything. And I'm in it for the long haul because I like refrigerators.
Yeah, and being honest, I think that that's the right way to approach this market in particular. It's funny how, and by the way, everything I'm about to say is not financial advice. Throwing that out there before I go on. I find it interesting because I always find that financial psychology is backwards. It's when people are euphoric and they see other people making money, that's when they throw money into the market. And really, that's the riskiest point. If, say, we go to 10K, that's a downside of 50%. Like you said, is Bitcoin going to? Yes. 10K is an excellent entry point, or 20K or 30K if you're thinking it's going to go to 100,000, 500,000 or $1 million.
Yeah.
So I mean, my viewpoint is I'm just accumulating, and there's a lot of I'll say I've definitely honed in on what I consider value in the altcoin market. It's very important to understand a unique proposition beyond just fast and cheap. So I mean, keep that in mind. Everyone offers fast and cheap, not financial advice. But
I would just add on to that. Again, I feel like if you're saying it, I should also say it because I want to be able to. This is not financial advice, but I think you're totally right. I would say the following thing. The first downturn that I experienced was like the winter of 2018. It was right after the 2017 high, and I have to tell you, like, I was legitimately depressed. Like, I thought I was like the coolest, smartest person, because I was just making all this money. And then, within like, a week, I experienced my first downturn. And so in this round, because I went through that pain, I was a lot more sort of just smart about my money. And by that, I mean, I think that this idea of self-custodying money is so interesting, and it's going to be made so much easier as more and more people enter and they understand the value of self-custody. So I do think it's smart for people to self-custody. And then also, I think, I think that I compare altcoins to like fantasy soccer, fantasy football, right? Like they're like, I actually think that altcoins are going to be a great entry point for a lot of people to like get interested in the idea of like, altcoins, because, you have to be involved and you have to understand, price movements and what this thing is and what's the underlying value. And the real value of altcoins is that they get people eventually to discover other assets like Bitcoin and Ethereum. I think that right now is probably a good time to consolidate a lot of your holdings to things that, again, allow you to have a refrigerator in your kitchen. So what are the things that are going to allow you to have a refrigerator in your kitchen? And I would focus on those and continue to hold those. And the last thing I'd say, everyone always likes to say that Bitcoin's going to 1 million when it's going on the way up to like 20,000, 30,000, 60,000. And everyone likes to say that Bitcoin's going to go down to 10,000 when it's going on the way down. What I've usually seen in my very short experience in being in like, what is this like now, 1.5 cycle, is that neither party's ever right. There's always somewhere that the things consolidate. I don't know if, I've seen reports, or I've seen very smart traders say that they think it's going to go down to 10, 11K. Again, I don't know. This is not financial advice. At the same time, I don't think that we've fully seen a lot of the contagion play out from some firms like Three Arrows.
Right.
So
That's a very good point.
Right. But I do think that I've seen that it's very cool to say that Bitcoin and crypto is going to go down when it's going down. And it's even cooler to say that Bitcoin's going to hit $1 million when it's on its way up. So the answer is always somewhere in between, right? Like what we hit the last up cycle, 70K. It's not quite 100K, but like, tomato potato. It was kind of close. It's so these things are just exaggerated whenever we go on our way up and on our way down.
Yeah, and I think one of the challenges in crypto too, and is the financialization of the industry. Yeah. And what I mean by that is you have your spot market, you have DeFi protocols, but once futures trading and leverage came into play, that meant that less people were buying the asset at hand and instead just speculating on its price. And I think that say those tools didn't exist, likely that would have resulted in the stock to flow model possibly working. Now, granted, I said earlier, I'm not a guy who follows models. I just see a lot of value being here. If Congress is having a conversation about the value of these assets, why they matter, and how it should be regulated, there's probably an incredibly way higher underlying value to be had there. The bill didn't call Bitcoin currency, even though if you read the white paper, it's currency, So, I mean, bear that in mind. There's always going to be players that want to see it go down, just as there's players that want to see it go up. And there's never a moment where someone isn't making money, just like there's never a moment where someone is losing money. So I just think it's important that you, especially for those of you who are watching, this is just advice in general. If you're getting involved in something, ask yourself why you're getting involved and have a plan. If you're going to stay long, stay long. If you're just going to get in and out, get in and out. But don't let the game pull you in further and further away from your plan, because that's how you lose.
I would just add that although that was general life advice, that probably wasn't financial advice.
But yeah, definitely not.
And then the only thing that I'd add there is, I think the other thing that this the last bull market showed was that, there's a lot of claims that are out there that are going to be made, that were made, and will be continued to be made, that when you kind of dig into it, may seem too good to be true or don't really make sense. And I guess I've kind of found that, like, usually whenever you have that question and you kind of circulate with your friends and ask them and they don't really have a good answer either, it's probably too good to be true if it feels like it's too good to be true. And so look, I mean, Jorge, I don't know exactly how old you are or whatever, but like my first memories of the internet were me like being like 10, 11 and sneaking into the library. And back then you had to like sign up to like use the library on like some sheet, right?
Right.
And like I would like go and hide my screen to like go and like play like chat roulette on AIM, right? Where I was chatting with like God knows who these people were, right? Like but like my dad hated it. Like I was on there asking people for their ASL and like trying to be, like an 11-year-old boy, right? Like that was the first exposure to the internet. I kind of see a lot of the same patterns here in crypto, maybe even on steroids, because the first use case of crypto as a refrigerator happens to be associated with money, right? Mm-hmm. So like a lot of this thing where there's a lot of scam and BS is present just as like it was for the internet. Again, like we do not use the internet today to ask people what their ASL is. Well, I mean, but like now the internet is just so embedded, like it would be weird to say that like I'm using the internet. Like it's just, I mean, it's everywhere. And so we're kind of, I see the same thing where like people are out there right now, like on AIM, whenever you ask them what their ASL is, they'll say, yeah, I'm a, like 60-year-old man worth $70 billion living in Malta. Like it's, like there's a lot of stuff out there. And so it's probably not true, or like there's a lot of scammers out there. So if something's too good to be true, it probably is. It doesn't change a lot of the fundamental value of what's being built.
And just adding on to that, I think who says it really well is Miles Deutsche, who I met in Miami at the Bitcoin conference, and
Right.
he says really eloquently, if you can't find where they get the yield, you are the yield. So just keep that in mind. There's a lot of people who are coming from a good place and just experimenting and trying to improve this technology, improve the space, and improve everyone's everyday life, and there is a lot of that, and there's going to be people who make mistakes along the way. And that's just a part of technology. Before this is money, this is technology. So I think it's important to understand that technology improves over time, how we use it improves, our views on it, the culture. So, I mean, it's interesting. I mean, and crypto, I feel like a week is a year. So, man, whenever we shoot the next episode, it'll feel like 50 years, I bet. But
I couldn't agree more.
But Paul, I just wanted to say, I like what you're doing. I really appreciate your time. I look forward to seeing the evolution of Archie over this really interesting period. It's the people that build that are planning to build when things seem desperate that I think are going to make it out alive. And I look forward to seeing Archie on the other side. Again, thank you so much. I appreciate your time. Before I let you go, is there anything you want to tell the audience, or anything you want to say about Archie Finance, or maybe just something you want to say for anyone?
We're a young company looking to do amazing things and allow you to take control of your finances and your identity. So give us a follow on Twitter. We're at Archie Finance, and stay safe out there. I thank you for having me. Jorge, I love having these talks, and it is a bear market, but these are where a lot of the interesting stuff are built. So be smart, ask questions, and stay safe. So thank you for doing things like this. I think things like what DBF is doing are just so important to just educate people, and just like talk about things instead of just like trolling each other on Twitter, which is also fun. Big fan. But like having fun conversations where we can help each other get a better understanding, always such a good time. So thank you.
Hey, thank you so much. And I just wanted to say thank you so much for saying that. The whole point of Degens for a brighter future, for anyone that's watching on the other side, is to show you that everybody behind, a lot of these people behind the projects are just regular people trying their best to make it by, or to improve this, honestly kind of crummy and disparaging financial system that we have right now. So I appreciate your hard work. If you want to learn more about Archie Finance, links down below in the comments. You can get to the website. You can follow them on Twitter. You can also find my personal Twitter. You can find Degens for a brighter future. Please subscribe. Please like. Follow us on Twitter. I look forward to hearing from you guys again. And Degens safely. And before you go, I have an outro song. And here we go. Wait, advance. Crap. I did this wrong this time. Here. Oh, is it on? Shit. There. Now we got it. Anyways, thank you so much for watching. I'll have up here episode 7, our conversation at Dartford. If you haven't seen it, please watch it. Paul's gonna watch it, I bet, hopefully. Alrighty. Well, anyways.